You have heard me say this before. A structured note is a product issued by a bank. JP Morgan, Goldman Sachs, Citibank, these are the names you see on term sheets. Now here is the question most people never ask. What happens to your money if that bank fails? I came to Dubai in 2008. That same year, Lehman Brothers collapsed. One of the biggest investment banks in the world, and it went under in a matter of days. Investors who held structured notes issued by Lehman lost everything. Not because the market crashed, because the issuer collapsed. That is what we are going to talk about in this video. Is your structured note actually safe? And how do you evaluate that before you invest? Before we go further, a critical reminder. This video is for educational purpose regarding counterparty risk. I am using specific bank names and historical events to illustrate concepts, but this is not financial advice or an endorsement of any specific institution. Credit ratings can change and all investments carry risk. When you buy a structured note, you are not buying a stock. You are not buying a piece of a company. What you are doing is lending money to a bank, and in return, that bank makes you a promise. They say, at the end of this term, we will pay you back your capital, we will pay you your coupons, we will honor everything written in this term sheet. Now, here is the part most people miss. That promise is unsecured. What I mean to say is, there is no collateral behind it. There is no pool of assets set aside for you. There is no government guarantee protecting your money. If the bank runs into serious trouble, if it cannot meet its obligation, you are standing in a queue behind depositors, behind secured lenders, behind others who have a stronger legal claim than you. And at the back of that queue, you may get very little or nothing at all. This is what we call counterparty risk. It simply means the risk that the other party to your contract cannot keep their promise. Now, for most notes issued by strong banks, JP Morgan, Goldman Sachs, Citibank, the risk is very low. These are institutions with enormous balance sheet. They are heavily regulated, they are watched very closely. But low risk is not zero risk. And history has shown us more than once that even names we trust can fail. That's why I say evaluating the issuer is not a formality. It is the most important step before you invest in any structured note. So how do you know if a bank is strong enough to trust? The starting point is credit ratings. There are three main rating agencies in the world: Moody's, Standard & Poor, which most people call S&P, and Fitch. These agencies do one thing. They look at a bank, its finances, its debt, its risk, and they give it a grade. They publish their findings publicly, and the conclusion is simple. How likely is this bank to honor what it owes? That is all a credit rating tells you. Now the scale works like this. At the top, you have AAA, that is the highest possible rating. Extremely strong. Very few institutions in this world hold this. Then you come down AA, then A, then BBB. Everything from AAA down to BBB, that is what the industry calls investment grade. Those are banks considered financially sound, capable of meeting their obligations even under pressure. Below BBB, you enter a different territory. BB, B and lower, this is what the industry calls speculative grade. Some people call it high yield. And this distinction, investment grade versus speculative grade, this is the line that matters most to you as an investor. Sometimes you will see a structured note offering a very attractive coupon, maybe significantly higher than what a top tier bank is offering, and the issuer is a bank you may not recognize immediately, or a bank rated BB instead of A. That higher coupon is not a gift. What I mean to say is the bank is paying you more because they have to. They are a higher risk borrower, and to attract investors, they need to offer more. For argument's sake, Say Bank A is rated AA and is offering a coupon of 8% per annum. Bank B is rated BB and is offering 12% per annum. That 4% difference is not free money. That is the price of additional risk. That is the market telling you this bank carries more uncertainty than the first one. And the question you have to ask yourself is that extra return worth it? The answer depends on your overall portfolio. A small allocation to a higher yielding, lower rated issuer as a part of a diversified mix can make sense. And even with a higher rated bank, putting everything with one issuer is not the right approach. Diversification across issuers matters regardless of the rating. That's why I say always start with the rating. It is not the only thing you look at, but it is the first thing. Before the coupon, before the structure, check who is issuing the note and check what grade they hold. Let me tell you about Credit Suisse. 150 years of history. A Swiss institution with a global presence, one of the most prestigious names in private banking. For decades, investors around the world associated Credit Suisse name with safety, with stability, with the kind of institution that simply does not fail. And many investors who held structured notes issued by Credit Suisse felt exactly that way. If anyone was safe, it was them. Then 2023 happened. It did not happen overnight. Years of scandals, risky investments, management failures, one problem after another, and eventually the weight of all of it became too much. The Swiss government had to intervene. Credit Suisse was forced into an emergency merger with UBS, one of the most dramatic collapses in the history of global banking. Now, what's happened to investors holding Credit Suisse structured notes? For most structured note holders, the note were transferred to UBS. The terms remain, the obligations carried over. But there was another group of investors, holders of what are called AT1 bonds, a specific type of debt instruments issued by Credit Suisse. These investors were wiped out completely, 16 billion US dollars, written down to zero. And here is the lesson I want you to take from this. Credit Suisse was not some small unknown bank. It was not a name nobody had heard of. It was 150 years old. It was one of the most recognized institutions in the world. And it still failed. This is why I keep coming back to the same point. The strength of the issuer is not a background detail. It is the foundation of the entire investment. No coupon, no matter how attractive, is worth ignoring who is standing behind that promise. So we have talked about credit ratings, we have talked about what can go wrong. Now let us talk about what you can actually do. How do you evaluate an issuer before you invest? The first thing is the credit rating. We have already covered this. Investment grades is where you want to be. AAA, AA, A, BBB, that is your starting filter. But the rating alone is not enough. Here is something most people do not know. Credit ratings are not updated every day. They are reviewed periodically, and sometimes a bank's situation can deteriorate faster than the rating agencies can react. So the second thing you look at is the direction of the rating. Has this bank been downgraded recently? Is it on a negative outlook? There is a big difference between a bank that is rated A and stable and a bank that is rated A but was AA 6 months ago. The rating is the same, but one bank is stable and the other is sliding. Those are two very different situations. The third thing is the news. This does not require financial background. Simple search the bank's name, look at what has been written about them in the last 6 to 12 months. Are they in the news for the right reasons or the wrong ones? Lawsuits, regulatory action, large and unexpected losses, senior management changes, these are all signals worth paying attention to. The fourth thing, and this is something your advisor should be doing for you, is looking at the bank's capital ratios, specifically something called Tier 1 capital. Without going too deep into the technical side, Tier 1 capital is essentially a measure of how much of a buffer a bank has. How much can they absorb before they can run into serious trouble? The higher this number, the stronger the bank's foundation. Now, you do not need to calculate this yourself, but you should feel comfortable asking your advisor what is the Tier 1 capital ratio of this issuer and how does it compare to their peers. If your advisor cannot answer that question, that is also a useful information. And the fifth thing is simple. When in doubt, walk away. If a bank is rated below investment grade, walk away. If there has been a recent downgrade or a negative outlook, ask more questions before you commit. If the news is full of problems and your advisor cannot give you a clear picture, walk away. No coupons justifies taking on risk you do not fully understand. A practical way to start: search the bank name and credit rating, then search the bank name and financial news. 2 searches, 5 minutes, it will tell you a great deal. So we have talked about how to evaluate a single issuer. But here is the next question. Even if you are satisfied with the issuer, how much of your portfolio should sit with that one bank? The answer is not everything. This is something I see quite often, and investors find a note they like. The issuer is strong, the coupon is attractive, the structure makes sense, and they put their entire allocation into that one note from that one bank. That is concentration risk, and it applies regardless of how highly rated the issuer is. Think about it this way. Even the strongest banks operate in an environment they do not fully control. Regulations change, markets shift, management changes. Things that nobody predicted can happen, and sometimes they happen quickly. So what does a sensible approach look like? You spread your structured note portfolio across 2 or 3 issuers. Maybe JP Morgan for one note, Goldman Sachs for another, Citibank for a third. Each of them is investment grade. Each of them is evaluated properly, and no single bank holds everything. This way, even if one issuer runs into difficulty and the probability with the strong bank is low but never zero, your entire portfolio is not exposed to that one event. Diversification across issuers is not a complicated idea, but it is one that many investors overlook. Because when everything looks fine, it is easy to assume it will stay fine. That is exactly when you need to be paying attention. So let us bring this together. A structured note is only as strong as the bank standing behind it. The term sheet, the coupon, the structure, none of it matters if the issuer cannot honor its obligation. Counterparty risk is real. Credit Suisse reminded us of that. Lehman Brothers reminded us of that before it. So before you invest in any structured note, check the rating, watch the direction, read the news, ask about the capital ratios, and spread your exposure across more than one issuer. These are not complicated steps, but they are the steps that separate an informed investor from one who is simply trusting a name on a piece of paper. In the next video, we are going to look at how structured notes compare to bonds and fixed deposits. How do they actually stack up on returns, on risk, on flexibility? I'll see you there.